Hey, good afternoon, traders. This is Trader Tim from E-mini Mind. Today's Thursday, March 2nd, 2017, and in today's video, I wanted to talk about how I manage the very first trade setup of the day. I'll talk about what that setup is, and then how you can come into each day looking for the same setup. And so that we've got a daily chart here in front of us, and this is the E-mini S&P. And the start of the day for me is the trading hours only, NYSE open. So I will start looking at the markets prior to that, an hour or so before the NYSE open. And sometimes we'll have a setup into a gap fill or something in the pre-market that allows us to get in before the markets open. But the day really starts at that New York Stock Exchange open. So first thing I do is I look for, where are we opening in relation to yesterday's close. And so the 2 days I want to talk about are Wednesday and Thursday, two great examples of a gap up, which was Wednesday. The market gapped up at the open, and then today, Thursday, the market opened up within the previous day's range. So if we go to a 5-minute chart, what I like to do is when the market opens outside of the previous day's range in the form of a gap, I like to bracket that first 5-minute bar by simply putting a buy stop above highs, sell stop below lows, and using that as a way to get into the very first, an early trade about 5 minutes or so right after the open. So Wednesday we had a gap up scenario, and I'm okay with going long above highs and going short below lows. We're either going to gap and go, continue in the direction of the gap, or we're going to turn around and fill the gap, close that gap. So either way is okay to me. How I manage the trade, doing a buy stop above highs, in this case, just one tick above highs is all you need. Then once that gets filled, I'll use a 6-tick stop. And then as the market continues on in my favor, I'll start to trail my stop. And it's only when the market, each candle, begins to make new highs and starts continuing in my favor. So what I like to use is a trail stop for this. So getting in at a 23.83.25, one tick above highs, and it's really the second candle that is filling you. So then we have a minus 6-tick stop that goes out. And once this second candle, once the high is broken, then I can start trailing my stop up underneath each candle. So it's not until the 1, 2, 3, 4, 5, 6th candle that breaks that, we'll call it the entry candle's high. And then I can move my stop underneath from -6 up underneath this candle. And then when the next candle closes, I can move my stop up underneath that candle. So we get into a couple situations here where, okay, the 8 o'clock candle has closed. So I move my stop up underneath that candle. Well, then the next candle's inside. The high and low is within the previous candle's high and low. So I just leave my stop alone, because then we get these situations where we have a consolidation and then before the market typically will move higher. And if you get too aggressive, and if you tighten your stop underneath the inside bars, then you can get chopped out before the market has a chance to continue on. So I leave my stop alone when we have these inside candles. But then this third candle here breaks the large body candle, that 8 o'clock candle. Once that candle closes, I can move my stop from underneath the big body candle here up underneath this candle. and then the 820 candle closes. I can move my stop from the previous candle up underneath that candle, and then what do you know? Market starts to pull back a little bit, and that's the candle that takes us out at 820. So we've got an entry at 23.8325s and staying in the trade all the way, getting stopped out at 23.8775s. And my stop, I'm just putting it one tick below lows. So if we contrast that to today, where the market opened up within the previous day's range, I will pass on the first 5-minute setup, because when we open up within the previous day's range, it's the market telling me that there's more balance between the bulls and the bears. When we open up in a gap, one side has more control, in this case the bulls, as of Wednesday, pushing the market up. So you'll get instances where the market does open up within the previous day's range and you can get some follow through, but typically if we look at today's morning, you have a lot more indecision, almost straight sideways chop this morning before getting into some kind of stair-stepping down into sort of the lunchtime session. So it doesn't mean that I don't take any trades in these days. It just means that I don't take that first 5-minute trade, and instead I give it about 15 minutes for the market to settle out. Then I start looking at retracements and allowing the market to kind of develop some sort of a rhythm after that first 15 minutes has occurred. The last thing I want to talk about, I get questions a lot, is when we get a situation where, so yesterday, Wednesday, the market moved up and then it pulled back and then it took off again. Well, if the first setup is a 5-minute breakout setup, and then we start turning to the Fibonacci retracements, and if we just draw up from lows to highs, what would have been trading hours only in the morning, and the question I get is, well, what happens if the market doesn't touch the 50? If I draw up my low to high and I put my order out there at the 50 and I don't get filled, is there an opportunity to get into the trade still? And the answer is yes, when we're in these strong trending environments. And what you can do is the same scenario, the same entry as we used for the first 5-minute bar, just by using a buy stop above the lowest candle's high. So the market's pulling back. You'll notice that we don't break the previous candle's high until this 840 bar. The market comes back close to the 50 but doesn't get all the way there. So you can use a buy stop above highs, same 6-tick stop, and then it's the 845 bar that gets you in. Take about a point of heat on the trade, and then the same trail stop method can be used as we start to the trade starts to go in our favor. Just move our stop from -6. Once the 855 bar closes, you can put your stop underneath that. Next candle is inside, so I don't move it. The next candle breaks out again. Once that closes, put my stop underneath that candle. Next candle, same thing, inside bar, so I just leave it alone. Next candle and continues higher. So you notice all the way up, we don't break the previous candle's low all the way until the 1015 bar. So just because the market doesn't pull back all the way to the 50, doesn't mean that there's not an opportunity to get into a trade using the 5-minute breakout method kind of in conjunction. And I only use that when the market is trending very strongly because sometimes the market will pull back, not get all the way to the 50, and then get a little bit of a bounce and then blow through and change direction. So if we're range bound, or if we're trading within the previous day's range, I only like to get long and short at the 50% retracement. But when we're in these situations where we have, you know, a monster gap up and a strong continuation in the morning and then a pullback, you know, I want to get into, if I get taken out of the trade, like yesterday, Wednesday, you know, nice move in the morning, get taken out, and then let the market pull back and look for a re-entry. You know, that's kind of the strategy going into days like yesterday where we had gap and goes. So two good examples back to back of a gap day with the first 5 minute where the setup is valid, and then an inside day where I pass on the first 5 minute setup. So if you have more questions or if you want to join in on the live trading, we do that Tuesdays over at eminimind.com/VIP. You can join us and we'll talk about the setups in real time. And if you have other questions, I'm always available. Tim at eminimind.com. Thanks, everyone. Have a great weekend.